What's up? Welcome back to Beyond the Keys, the Pat Lotz podcast. As always, Chris. Today I am welcomed by another great guest, our preferred lender. How long have you been working with Pat with Pat? 20 years?
Well, pretty close.
She says 20 years.
Pretty close. I've been with John Adams for 20 going on my 22nd year now.
Okay.
But I didn't start at these offices. I was at Corporate Real Estate 1
Southfield.
Back then it was actually on Orchard Lake and 13 Mile. Then they moved to Southfield, and then I come out and took the offices here in Brighton, in South Lyon in 2007.
I was going to say showing your age, but no, showing your experience.
Absolutely.
Showing your experience.
I always tell clients, it's funny, I always tell clients when I tell them about me, I'm like, okay, I'm about to date myself. I've been in this since 1997. Mm-hmm. I call it, I've been doing this since coming out of the womb, AKA college.
Yeah.
So, doing this a long time.
Even like speaking your language a little bit too, you probably saw UFC 1. Right? You're a big UFC fan.
I'm a big UFC fan, yes. I did not quite get into it at UFC 1, though, but pretty close.
What are we on right now? UFC?
2, they just had 284, I think, last Saturday.
Yeah, off the top of my head, I was going to say probably close to 3, so I'd be right on, like 283.
Yeah.
That's funny. Now I want to look up who was UFC 1.
I actually know who UFC 1 was. I believe Hoist Gracie won UFC 1.
Okay. And Gracie is probably not actually, I don't know the history, but Gracie has a big name within Brazilian Jiu-Jitsu.
Absolutely.
Founder or just kind of
No, very prominent name in Brazilian Jiu-Jitsu.
Mm-hmm.
And if you ever see Hoist Gracie and you look at him, you're going to laugh because he was a very skinny guy, wore a gi, and would beat guys that were heavyweights.
Yeah, 250 plus or whatever it was.
Crazy.
I think I've seen some of those clips too of like the originals just on social media when you're scrolling because I do like to watch the UFC things and I am a big Dana White fan.
Yeah.
So when I see some of the old school UFC things, even like from the early 2000s, you're like, damn.
Yeah.
When did UFC start?
1993.
Okay,
they're celebrating their 30th year this year.
Gotcha. So, and I was the reason I asked that is I said 2000. I'm like, shit, did it even start in 2000? But 1993.
1993. Yeah.
So normally when I'm introducing you to people, I always say John Millard, John Adams, and I always think that's so funny because sometimes people get confused and they go, so what's his name? Is it John Adams or John Millard?
I get that too sometimes. I'll have a client on the phone go, "Are you John Adams?" And I'm like,
yes.
No, he died a long time ago. He was like the second president of the United States. But I said, I'd like to be John Adams. Yeah. I wish I owned the company.
I'd have a different amount of zeros in my bank account, maybe.
For sure.
So let's just dive right into it. We were just talking off camera. I think that this is good information for consumers because they don't necessarily, and there's a lot of factors, but we were just talking about the housing, the jobs report and how it affected interest rates. Yeah. Well, we're trying to curb inflation. Rates were coming down. I saw it about a week and a half ago, and this is an average. It's obviously not the what it actually is, but about a week and a half ago I was in Vegas at a Tom Ferry event and everyone was talking about it. 5.99. Yeah. Next day 6.45. Yeah. I heard, again, a lot of factors. I heard that a big impact on that was a jobs report. Not hoping, but the government was not hoping, but they were expecting jobs to be lower and unemployment to be up. So how does that kind of affect interest rates?
Well, at the end of the day, what happens is economic news, the sentiment will swing things one way or the other. Mm-hmm. Like for instance, when the Feds move the prime rate, right? When the Feds move the prime rate, a lot of times people think, oh, the rates have just gone up. Well, that's not necessarily the case. It depends on how. So when the Feds move the prime rate, what that does is your credit card rates will move, your home equity loans, your short-term, your revolving debt, we call that revolving debt, will move right away. Your long-term mortgage rates will follow suit one way or the other, depending on how the financial markets look at what the Feds did. So if the financial markets look at it positively, you get a certain movement in rates. If they look at it negatively, you get a certain movement in rates. So we've had, in my career, we've had where the Feds have moved the prime rate and our rates go down. and then we've had it the opposite way. So it really just depends on what how the financial markets look at what's going on.
And there's a lot of factors.
So like we were talking off camera about the 5.99 to the 6.24 or 6.44 or whatever. And I was telling you that it really depends on what's in the fine print of what's being charged for that rate. Meaning in the fine print, the 5.99 might be 2 points in the fine print, where the 6.44 might only be quoting 1 point in the fine print. The rate costs, they always fluctuate off each other. In other words, when I put you, like if you came to me for a mortgage, and I put you into my system, I'm going to get a rate sheet anywhere from, let's say, 5 to 7%, and it's going to move in 1/8% increments. And next to that's going to be what we call price, and that's what is the client paying for that. The lower the rate you're paying. The higher the rate, we start to give you a credit. Typically, the sweet spot is what I call the no point rate, or that you're paying nothing extra for that rate. That's usually the sweet spot, meaning if you go lower, you're not getting enough bang for your buck of what you're going to pay. And if you go higher, we're not giving you a good enough credit for your buck. Sometimes that's not always the case, though. If I see a market fluctuation where I can go charge you only 1/8 in cost, so that would be $125 per 100,000, and I can get you an 1/8% drop, so it's literally 1/8 for 1/8. That's something to do, because now if you're going to swap, maybe, I don't know what your loan size is, it's going to change mortgage payment wise, but now if you're only paying 1/8 in points to get an 1/8 drop in rate, if that's where the market is, then it makes sense to jump on that. At the end of the day, what I do is I lay that all out for the client, make sure that they understand, okay, here's your break-in monthly payment. This is what you're paying for it. Here's your break-even point. Does it make sense? How long do you plan on being in the house?
I was just going to transition to that. Is you always talk about break-even points. Is why would I pay upfront points depending on what my expectation is for how long I'm going to be in the home? If you're going to be in the home for 20 years, then it does make sense in some capacity to make sure you get that lower rate. Granted, if we're paying X amount of dollars to get 5.5 or 6% at this point in time, what's that break-even point? What are the chances within that break-even point, rates go down, I can refinance for, no blood on my hands?
That's a good point. So I'm going to give you a couple examples of my career, one personally, my personal life, and then a couple in my career, of why points are a little tricky. Because you don't know what the rates are going to do, right? So let's go back to when I bought my first house. I bought my first house in 2000. Thought I was going to be there forever. Little ranch, if you'd asked me in 2000 would I be moving in 2003, I'd have said no way, not going to happen, because it was my first house, right? By 2003, life had totally changed. Kids were busting out the seams in their bedrooms. Income had changed. We actually inherited some money. By 2003, I'm upgrading. Well, had I paid points in 2000, let's say I paid a boatload of points in 2000 to get my rate so low, well, that didn't do me any good in 2003 when I'm moving up. If the break-even point was 5 years out, I would have never recouped that. So I'm really, really not a big advocate of paying a lot of points to buy down. Now let's speed up to 2019 and then the COVID crisis. 2019, I probably was closing people probably low 4s at that time. Usually, and this is general terms, so obviously it's always different depending on what the market's doing, but usually 1 point will drop your rate about 1/4%. So 1 point, so just so the audience knows, 1 point is 1% of your loan size. So if you got a $100,000 loan, 1 point is $1,000. $200,000 is $2,000. So usually if you're paying 1 point, now that's on top of all other costs. That has nothing to do with like appraisal fees, title fees. That's just for the rate. 1 point will usually drop your rate, usually around 1/4%. So now
it's not much.
It's not much. No. So now when you talk about 2019, I'm closing people at 4, 4.25, somewhere in there, maybe even in the high 3s. Let's say they paid a point. Let's say we got a $300,000 loan size. We'll just go there, $200,000 loan size. It really doesn't matter, but they paid a point. All right, to get from 4.25 to 4. Well, in the pandemic, we were in 2% rates. Well, is anybody going to go, I'm not going to refinance because I'm not going to recoup the $3,000 I paid last year? No, you're going to do it, and you're just going to bite the bullet. Yeah. Because obviously 2% rates is way better. Yeah. So so that's why I'm not the biggest advocate of points. Now, obviously everybody's scenario is different, where points might make more sense or not make more sense. But you got to be just real careful there because you never know when rates go down. You're going to refinance whether you paid the points or not.
Yeah.
If it becomes beneficial to you.
Two things. What were rates in 2000 for your first house?
So I don't remember exactly what it was in 2000, but I can tell you what it was when I got in the business in 97. So when I got in the business in 97, the no point rate was just under 9%. It was about 8 7/8.
That house you bought in your first house was 2000, right?
Correct.
What was that house worth? What'd you pay for
We
it?
paid for 120, I think.
120. What is it worth today? If you had to guess.
Probably 250.
Okay.
Maybe.
So things are going up.
Yeah.
And it's obviously relative to where points are to where the, fair market is. But at the same time, a lot of people are asking us, hey, you're seeing a huge decrease in appreciation, correct? I'm like, not necessarily. It's relative. I call it a spectrum. My house, it's always a fair market range depending on rates, time of market, time of year, buyers in the market, and all that timing needs to come together. So for us, a house could be worth somewhere between $350 and $320. Where are we at in that range? At 6.5, we're closer to that bottom. At 5.85, we're a little bit closer to the top or that middle. So I always try to relate it back to that.
Yeah.
Were you going to say something?
No, I was going to say, at the end of the day, you're right. I mean, when you're talking about the rate fluctuations, it's going to have an impact.
I think my brother-in-law, going back to refis from 2020 to today, I guess, I think personally, even my brother-in-law refied at 4, and I think he refied a second time at 2.8. Mm-hmm. And I think he paid 0 points. Is that true or not? Did he refi twice?
If you remember?
So,
yes. So what happens is, people will refi multiple times. Here's what I say about refinancing. If the benefit is there, you take it. And the way I explain that to borrowers is, look at the stock market, right? I like to dabble in the stock market. And let's say I'm watching a stock that I like. I like the company. But let's say they get some catalyst news that is going to hurt them a little bit. So everybody's jumping ship, right? And the stock price is going down, but it's still a stalwart company. Mm-hmm. So I'm watching it because I like it in the stock market. And the price is going down. I'm not going to buy that at the bottom of the barrel. I can't. Because I don't know what the bottom of the barrel is.
Yeah.
I won't know what the bottom of the barrel is until it starts to come back up. Mm-hmm. Then it becomes a hindsight position.
Yeah.
So I might buy it as it starts to come back up. I grab it there. So now I want to make money off it. So now I'm going to watch it soar, right? The catalyst news gets farther and farther in the rearview mirror. Some good news comes out. Maybe they release their earnings and their earnings are great. And now the price starts to go up and I'm watching it and I'm going to take my profits. Well, I'm not going to probably get, unless I'm really, really good, which nobody's excellent in the stock market, but I watch it go up, up, and up, and up. I'm probably not going to sell it at its peak. Why? Because I don't know what the peak is. Mm-hmm. So then once it gets to its peak and it starts to come back down, then I sell it and I've made the profit from where I bought it to where I sold it. Well, interest rates are no different. When you've got a client who's, let's say they're at 6% and now the rates are 5.25% and they're going to save, depending on loan size, let's say they're saving $100 or $200 a month, whatever that number is. Maybe they're getting rid of their mortgage insurance or whatever to save more money. And they're like, what do you think rates are going to do? It's like, well, for one, I don't have a crystal ball, but right now you're saving this amount of money.
Yeah.
Now, if the benefit's there, so we're going to analyze that. First question I'm going to ask you, how long are you going to be in your house? Well, I plan on being there for the foreseeable future, at least 5 or 10 years. Mm-hmm. All right, we're going to take the costs. We're going to take the rate, the monthly break. All right, the break-even point is 18 months. If the break-even point is 18 months and you're going to be there for 5 years,
I'm taking it.
There's no reason why you shouldn't do this. Mm-hmm. So you do it. Now, but what if rates drop? Well, what if they do? So if they drop, you jump on this benefit. If they drop again, we're going to analyze the same benefit to make sure, same thing. All right, you did it at, 5, or they're at 6, they were at 5.25. Now the rates dropped to 4.25. You didn't have that hindsight. It's a hindsight position that you didn't have. Mm-hmm. But now we're going to save you another $150 to $200. Your break-even point is again 18 months, and you still plan on being here for the next 8 years. You do it again. So what I say to clients, if you tell me, if your break-even point is 18 months, and you tell me, and we're in, what are we in, February right now? Mm-hmm. You tell me you're going to sell your house in May, then I will not do your refinance.
No.
Because it does not benefit you.
And you don't make money. You specifically.
And I don't make correct, right? Which is fine because
Yeah.
we kind of are along the same lines of integrity. I got to look myself in the mirror at night, you know, and say, hey, I'm doing right by my people. So you don't do it, I won't do it. But if you tell me I don't know, if I say, well, how long are you going to be in the house, and you say I don't know, then I say, okay, well, let's analyze. I don't know. All right, your break-even point is 18 months. The benefit is now to get $150, $200 a month. Well, if I don't know turns into 15 months, when your break-even point was 18 months, you lost a little bit of money. But you got close. You didn't lose it all. You got close to the break-even. But if I don't know turns into 10 years and you didn't jump on this, you're going to be kicking yourself in the butt if rates go up. So it's just a matter. It's like anything else. You gotta analyze the risk involved, and does it make sense for you?
Yeah.
If it does, we go. If it doesn't, we don't.
I always relate it back to appraisal guarantees to a certain capacity for the exact same thing, and not necessarily break even points, but like how long are you going to be there? You know, if we're looking for our 10 to 15 year house, then yes, it makes sense to overpay by $10,000 to $20,000 in a worst case scenario. If we're only going to be there and it's a temporary first time home, be at $2,000 to $5,000, you know, because even with an assumed 3% appreciation, you're going to be making money. You're still going to be appreciating over that overpayment by $3,000 to $5,000 in 2 to 3 years time. So I wouldn't worry about that stuff, but it's all about those break-even points. And that's the hardest part with real estate. That's the hardest part with lending is, one, don't have the crystal ball, but at the same time, guys, there's a lot of factors into this. Yeah. I like that analogy though, because even for the people that, granted, they jumped on an opportunity to fit their needs to go from a 6 to a 4.25. But I think hindsight, and I love this quote, the 3 best investors, woulda, coulda, shoulda.
Yeah.
But at 2.8 on that uptick, John, I want to refi. And you get 3%. The difference between 3% and 2.8 is marginal, but still on that uptick to capitalize at the bottom of the market, stellar. And a lot of people still did that. And you were probably still refining. I'm sure you were refining a lot of people out at 4%, even more at 3%, and more at the low 3s and high 2s.
100%.
Yeah. So people, and as we just said, a lot of the same people.
Yep.
But it all goes back to that. If you're looking to refi, one, we refied, and we actually refied in the other direction. Unfortunately, we had to pay back some people. We went from 5 to 6, but I think in the big picture of my life, when it comes to refinancing, I, one, had to do it, and 2, 6% or 5.5% is still a phenomenal rate. We're short-term. We have short-term memory loss, or we have too much short-term memory, not long-term memory when it comes to rates. I think people are comparing these 6s, which, one, we're still listing homes, we're still buying homes. We got a bunch of buyers in our back pocket, first-time home buyers, upsizers, sometimes downsizers. And when's the right time to sell or buy? It's when you need to buy or sell. Correct. Not necessarily where are rates at, where's inventory at. Do you need to sell your home? Sell that damn thing. Do you physically need to buy a house? Buy a house. It doesn't make it a harder decision at 6. It makes it a harder decision at 6% versus 3. It is what it is. Yeah,
you know, it's interesting you say that. You know, it's like I look at it this way, like you know, you can get a sale on shoes anytime, right? But the question becomes, are you in the market for shoes? If you're not in the market for shoes, then the sale doesn't matter, right? If I go buy shoes on sale when I don't need shoes, I just spend money.
Yeah.
So it's like you said, when you're ready, if you're in your life when you're ready to buy. If you're not, if you're in your market to sell.
Yeah.
You know, the whole appraisal thing is interesting too, because of what a lot of people will think is that the appraisal is for them, and it's not really for them. It's for the lender to lend money. And if you line up, for one, an appraisal is not, and this is something I go over with clients too to make them understand what an appraisal really is. You know, an appraisal is not, it's not gospel. If you line up 10 appraisers and say, go appraise this house, you're going to get 10 different answers. Some are there is some subjectivity to it. It's just like if you line up 10 economists and say, hey, what's the outlook of America for the next 10 years? You're going to get 10 different answers. 10
agents, 10 lenders, 10 mechanics. 100%. You're going to get different things.
Yep.
Can we talk about my appraisal?
Yeah, sure.
We're not going to even touch on it long, but to your point, 2 appraisers, one person on my refi primary residence, one of them appraised at 330, one of them appraised at 385. And that's a big discrepancy. But at the same time, we had a few different factors. The inventory or the comparables for a appraiser was not there. By the time when we did the second appraisal, the comps did close, so they're able to use those things. So a few different factors. But anytime you talk to an appraiser, they always talk about how it's so analytical, very unbiased. And I appreciate that. But that's impossible with human nature. Impossible with human nature.
Yeah, and the picture you just pointed out, which was a true picture, by the way, that really happened in your deal. It also shows you how the market changes. The market changes, every time with every new sale is a new comp. So that could really, really make a difference. And then the industry as a whole, like my industry, your industry, you line up 10 of us, there's going to be three of us that are very good, maybe 4 mediocre, 3 of us aren't so good. Same thing in real estate. Appraisals are no different.
Yeah.
Quite frankly, I hate to say it, but doctors are no different, right?
Oh, yeah.
Why do you get a second opinion on a doctor?
Yeah.
Right? It's because you're going to have 10 doctors, you're going to have 3 really good ones, 4 mediocre ones, 3 that you wonder how they became a doctor, right?
Yeah.
So it's just human, like you said, it's human nature.
I say this all the time, and I don't know if it's probably a good thing I should be saying, but when I was a med device rep, we had 60 surgeons. I would let one of them touch me. That's the craziest thing for me to even think about. And it's not that all of those 60 were not great surgeons, but they're all not created equal in terms of bedside manner, surgical competency, the amount of cases that they see. And me and Pat will always relate it back to experience. I'm calling the guy that's doing 100 root canals a year, not the dude that's doing 1 or 2.
Right.
Is he still capable? 100%.
Right.
But at the end of the day, I think that experience truly matters. So years in the industry matters. Refis matter, loans matter. And if you're doing 1 or 2 a year, that's got different experience. Unfortunately or fortunately, that has tangible different experience.
100%.
So we're always telling these consumers is interview. Go get second opinions. We're completely fine with that. You say it, if you said it once, you said it 1,000 times. You're not scared to compete. You're not scared to come to the table. Nor are we when we're there to show our value. So ask someone a few questions. Where do you live? Where do you do business? I think that matters, because if I'm living in Detroit and I'm doing business in Livingston County, that's a different market. How many units do you do a year? That also matters back to that experience. And then 2, part-time versus full-time. We believe that to be a full-time agent is going to be an agent that excels versus, hey, I can only show these houses Thursdays and Fridays between X amount of times because I got a full-time job. To be able to adapt to this changing culture or changing environment of the real estate market, you're going to get left behind. So those things matter. And to your point, not all lenders are created equal, which we know that, and consumers see that. We were talking a little bit earlier today, like at the end of the day, it is transitioning to more of a commodity based industry. So how are you going to win, and how do you consistently win? Customer service, and you do win on rates, 9 out of 10 times. So, that part matters, but customer service and relationships, and you drive that point home.
Yeah, it definitely starts with being competitive, right? If you're not even competitive,
Check. Yep.
It's going to be hard to get them to even listen to you after that. So you got to be competitive, and we're competitive. I mean, I wouldn't be at John Adams for as long as I've been if we weren't competitive. I mean, you have to start there. So we are competitive now, but then after that, like you said, and I see it too, because I cater to Real Estate One agents. I work here out of the Brighton office. I'm part of the Real Estate One family of companies, and I see it too. The agents that are full time, hone their craft, are in the market, know what's happening in the market, are worth their weight in gold. I can't speak to that enough. Those that do it part time, God love them, but they're not in the market, and they'll speak to stuff that was in the market 6 months ago or a year ago, and they might lose it. They might not negotiate a good deal for their buyer, or they might lose a negotiation because they're not honed in on where the market is today. And and that's where the experience is worth its weight in gold on your side of the coin. Yeah. For me, it's educating. You got to educate borrowers. I mean, when a borrower comes to me, I realize that I'm the professional. I'm the one who's in this every day. They're not. Things that might be, easy for me to understand might not be so easy for them. They don't do it every day. it's important for them to know what costs are mine, what costs are the third-party services like appraisals and title companies, and and sift through those weeds of here's what I'm charging you for the rate I'm offering you, and here's what lender B might be charging you for the rate they're offering you. And then if for some reason we look like we're getting beat, then I'm going to go to management. We're going to go battle for that deal.
Yeah, I say you win nine out of 10 times. You think that's true? You think you got a 90% success rate? I think apples to apples.
I think if the borrower, if it's apples to apples and the borrower gives me a legitimate shot, I think it's at least.
Sometimes I say 10 out of 10, but the only reason you might not win 10 out of 10 is like maybe a credit union. So you might be losing maybe on some points or maybe on some costs. But at the end of the day, I still think that you're winning 9 out of 10 times to be confident.
Yeah, our company does a really good job of stepping up to the plate. Now, granted, I don't know what the company's making on the back end, nor should I. Yeah. Right.
Who cares?
Right.
If you're in the deals.
Well, and I always joke, I'm like, I don't know what the company's making on the back end because maybe I might question what they paid me.
Yeah.
But
I should get paid more.
Right. Of course, we all should, right? So, but at the end of the day, nobody's in the business to lose money or break even, right? Nobody works for free. The borrower that we're dealing with, we're working with, they don't work for free. We don't work for free. I mean, if I was working for free, I could. There's a lot of other things I could spend my time on, right? But so
like your the nonprofit you're associated with.
Yeah.
Like, hey, I love making money and I'm good at it and I've been doing it for a long time. But if I wanted to do community service, I'm probably not doing it here.
Right. Yeah. right. I mean, I work with at-risk youth,
but it's showing that, and I think that's the difference of the 9 out of 10 times is when you go up to the opportunity, and we just went through it. Mm-hmm. You were up against a credit union that was a credit union, and you provided what you call a mortgage cost breakdown. Correct. Or a good faith estimate.
Yep.
And let's go back to that, because this is what I always tell people. If they're working with somebody else, get this, and it's always worth having a conversation with one or two other lenders.
Sure.
I say that, but I also know that if you have that conversation, you're probably going to win. So I say, hey, go to X company, get a mortgage cost breakdown, a good faith estimate on everything, and it's general for the most part for a price point. It's going to become very specific to homes when it comes to taxes. More of anything, that's going to be the biggest variable when it comes to that estimate, and it is nothing but a estimate.
Correct.
But it's trying to give those buyers the best snapshot into what it's going to cost them, all of the associated costs, everything from prorations, taxes, insurance, principal, interest, miscellaneous fees, lender fees, title fees. It's going to give you that cash to close item. You were up against an interesting, again, normally credit union, it's going to be competitive, but you were up against a Word document.
Yeah, I was.
Did you look at that and just go like,
yeah,
hell yes?
Yeah. Well, the thing with that is that I'm not afraid to compete. But we got to get to apples, because without it, that's where I don't want to say shadiness, because I don't know any other loan officer from anybody. So I don't ever want to downplay anybody,
or know their intentions,
or know their intentions. 100%.
It could just be experience. This is how I was trained.
It could be experience. It could be this is how we do things.
Yeah.
It could be a multitude of things. So it doesn't necessarily have to be an ethical thing. But when you see that, the itemization is key. Because that's what allows you to sift through the weeds. The weeds of what is my lender charging me for the rate that they're quoting me.
Yeah.
We cannot make money off of third-party charges. So if the appraiser charges us $550, we can't go hit the borrower up for $600
and make the difference.
We can't do that. So I always tell clients, look, and I can literally take, because of the experience, I can literally take their cost breakdown, if it's itemized, to my cost breakdown, which absolutely will be itemized. And we can sift through the weeds and say, okay, let me tell you what this lender's charging you for their rate. Let me tell you what I'm charging you for our rate. And there's been times, Chris, when everything's been equal. I mean, literally within a couple of dollars. And I've literally said to the borrower, hey, listen, let me be honest with you. Both these are the same. They're both the same. The question is, who do you want to do business with? If it's the other person, I tip my hat off to him. I wish you all the best. If you need me, I'm here. But all the best. But if it's me, then let's go. I'm ready to go.
Yeah.
And I win those deals too, because I think it's about being honest. It's about being willing to say, hey, look, they're the same. They're doing good business. We're there. Who do you want to do business with? And if it is the other person, I don't ever burn bridges. I'll tell you this real quick. I had a situation years ago The bar was shopping me with, and to the agent's credit, they gave me a shot. Bar was shopping me with their current bank. We were very close. I think I actually might have even been beating them a little bit. But they went with their bank because that was their banking relationship. I didn't burn that bridge. I said, hey, I wish y'all the best. Really appreciate the opportunity. And I let them go on their merry way, and they bought their house.
Yeah.
I've done their last 2 refis because that didn't go so well for them. And when they called me up, and it was a decent sized loan, so I was hurting pretty good not getting the deal.
Yeah.
But then they called me, a couple years later, said, hey, I don't know if you remember me. We gave you a shot. We didn't use you the first time. I'm like, oh, no, I remember you. I don't want to tell them I jumped in the fetal position when I lost the deal. But I'm like, no, I remember you. And from then on, I got the next 2 refis. And because they didn't have the greatest situation or the greatest experience with their current bank. So sometimes you do tip your hat, and say, hey, we'll live to fight another day.
It's how you lose, though. So, and I think
100%.
that's like for you, and maybe not for the consumers, but for you, it's how you lose. And if you've lost that, one, we lose deals all day long, but it's saying, wishing you the best of luck. It's so-and-so agent, you're going to be taken care of. And I just said that the other day. It doesn't matter who you use. And I heard this term recently. It's called commission breath, where you don't have commission breath. I don't have commission breath. Hey, it's so-and-so. You got a great deal. That's apples to apples. Who do you want to do business with? And if it's me, let's do it. If it's not me, we wish you nothing but the best of luck. That still sucks. But at the end of the day, when a consumer hears, you think they're good? Yeah, they're good. I know who they are. You're going to be taken care of. And because I think those consumers at times are waiting for a pitch to say, you should not do business with them because XYZ. And you'll never do that.
Yeah.
You'll never do that.
Yeah, I don't mind losing because I'm confident I will win more than not. But I don't mind losing on a fair playing field.
Yeah.
If it's a fair playing field and I lose, maybe it's just personality. Maybe I didn't make them laugh as much as the next guy did.
Yeah.
Or maybe I didn't hit it off with them as much as the next guy did. I like to think I'm a likable guy, and that's not going to be the reason. But or maybe they've just had a relationship with them forever, and I'm the second guy in, and I just confirmed that, hey, who they really like gave them a good deal.
Yeah.
And that's okay too.
Well, the deal we were just talking about, you lost on interest rate, but they said doesn't even matter. Doesn't even matter, which we didn't see that fine print from the other competitor. But at the end of the day, you still won based on exactly what you just said, educating the consumer, and then also just relationship, period.
Yeah. If we're talking,
but we also don't know what that cost breakdown is, so you probably still won on.
Well, if we're talking about the right deal, I actually beat them in rate, not in cost.
Gotcha. Boom. That's what it was.
I had higher in cost.
And we're talking marginal,
$1,000. Right, and we couldn't break down what their costs did, and I had some suspicions that it was not lender costs of why that was.
Low taxes,
so
low appraisal fee, or not having an appraisal fee.
Not disclosing a homeowner's insurance premium that they're going to pay.
Yeah.
Maybe not disclosing tax prorations that they're going to pay. And these are things that I'm like, look, you're going to, whether I disclose them to you or not, come closing time, you're going to get hit with these. And these have nothing to do with our fees.
Yeah.
But yet I need to disclose those to you.
Just for peace of mind. You want to sleep at night. So,
right.
And two, you never want to have that conversation after the fact, which we just, not me and you, but me and another John Adams lender just 30 days in had a conversation with a consumer about a certain fee. We were like, time out. Like, that fee's been around since day one. Maybe I didn't hit that fee hard enough for you to understand that that's a fixed cost and that's not coming our way. But I'd rather, and you would rather have that conversation on day 1 versus day 28 to say, oh, by the way, that's a fee that's also kind of incorporated there. It doesn't matter how big or small it is. They want to know about it. In our case, she knew about it, but at the same time, who cares? Let's just move on with our lives.
Yeah. I think one of the reasons why I can appreciate working with your team through the years, because I think we work a lot the same way, is that I don't do just one deal just for this deal. Like, I don't want my client to get hit with out of left field at closing with a fee I didn't disclose or something that doesn't make sense of why it fluctuated.
Just keep talking.
Because we are talking about estimates. So at the end of the day, we're working for clients for life. I mean, that's really, to really be successful in this business, it's about repeat business. It's about building relationships. It's about not doing the deal just for this deal. Well, the only way I'm going to get this person in my client base for life is that there are no surprises at closing.
My line is, at the end of this deal, I want you to be comfortable, confident, educated that you know every single decision that you made, you understand it.
100%.
Where, again, I don't know what other real estate agents do, but I also think that a lot of real estate agents might say, 1, 2, 3 house, A, B, or C, choose, versus really educating them. And I think a lot of agents think that they're selling a home. It's a part of the process. It's a metric of how we make money. No different than selling a mortgage. But at the end of the day, it's the educational or the consultative approach to making sure, again, that it's just one deal, but that one deal turns into 5. And you'd be surprised, maybe not, you'd be surprised on how many times we get phone calls to say, no different than what you were just talking about, this was my experience in the last one, I want to avoid that at all costs on this next one. So the amount of times that we get business based on agents not going above and beyond on that educational standpoint is a lot. But that's also the difference of being in business for 3 years and being in the business for 25, 30 years. Actually, the first thing, and we touched on this a little bit ago for experience, when it comes to agent experience, that's the first thing that I look at from a listing agent standpoint. And I'm using that as a gauge about how this relationship is going to go off from a judging a book by its cover. And when I see the agent does 5 deals a year, that's going to be a different transaction than when an agent does 50 deals a year in terms of the work that I have to do or the work that they have to do. And that's where you want to see, 2 peas in a pod. We're working together for a common goal. I just wanted to drive that point home because I was thinking about it. Let's go back to, and we don't know, this is going to be a speculative conversation maybe from here on out, but how are lenders selling mortgage right now? Are they saying 6.5, but the fine print of points? Do you think that's an approach for a lot of lenders in this current market where rates are?
Yeah, well, historically, whether it be the media or advertisement, historically, lenders usually will do a point tied rate because they know the general consumer is chasing the rate.
Yeah,
a lot of lenders will quote the low rate and just, here's the cost associated with it, and they won't even spotlight the points. They'll just be like, here's the cost, this is the rate. And they won't really go over it unless it's asked. So usually, historically, the rates get quoted with some kind of points.
That's crazy to me. That's crazy to me.
Well, the reason being is because at the end of the day, what you want is you want your phone to ring. And then you'll educate them from that.
It's a marketing.
Right. It's a marketing thing. Yeah. Right. What I'm seeing is, what happened last. So, okay, 2 and 3% rates are not normal. They just weren't. I mean, they just weren't. At least not in my years of experience. And then if you talk about our parents and grandparents, they would laugh, and they were talking double-digit rates in the 80s.
Normal was 12%. I think if we look at historical rates, what do you think that average is historically? What should it be at? 10%?
Maybe
higher.
Depending on what era you're in the 80s, it definitely would have been higher.
Yeah, my guess would be somewhere between 8 and 12%.
Yeah, I think where we're at right now is, at least for my career, so my career spans 25 years, is about normal. I was when I first got in at 9, right before 9% in the late 90s. Then it trickled down. We were in the 6s forever. Then when it got to 5, or we were refinancing everybody, and you're like, oh, rates aren't going to get any lower. And then they got to 4, and you're like, rates aren't going to get any lower, and they get to 3. But I think, what happened last year was a very shock to the system. When you go from, I went back and looked at rates I did in January of last year, and we were still low 3s.
Yeah.
But by the end of the year or in the middle of the year, we're at 7.
So were you referring to what's not normal is the increase of rates that fast?
Correct. Okay. That was a huge shocker. Now, let me just be clear about rates, though, because historically, rates will go up quicker than they ever come down. So in my career, when the market's volatile, I can get priced for the worst. I've had it happen where it happens 3 times in a day. That's a lot. To get priced worse 3 times in a day is a lot. So when it gets volatile, it can get crazy like that. But when you're talking about the how quick it went from 3% rates to where we had clipped over 7 at one point, within a 6 or 8 month time frame, that's a lot.
And we're volatile right now, but we're volatile between 6 and 6.5.
Right.
Versus back what you're referring to is we went from 3 to 4 to 5 pretty damn fast.
Yeah, we shot up to 7.5, and then somewhere in there. depending on what your stuff is, and then we ventured down to where we're at now, and it's kind of stayed a little. You're going to expect fluctuations, right? But now it seems to be a little bit more stable. The market, at least in my experience with who I'm qualifying, seems to accept it as the kind of the new normal. At least right now. I mean, you still hear rates are high, but and that again goes along with educating. That rates are higher than they were, but where they were wasn't really all that normal.
And our phone's still ringing. Like, I got 20 buyers in my back pocket. So again, that goes back to what we were originally talking about is you should buy, you should sell when it serves you a purpose. Take these things into consideration. Again, it might make the decision easier or not easier, but at the end of the day, people are still buying and selling. And I don't necessarily think that, the inventory does kind of impact things from our perspective, from like a supply and demand aspect, 100%, but things are still competitive. We're still submitting offers somewhere between $250,000 and $400,000 that are getting 5 to 8 offers. So
I'm pre-approving a lot of people. So my volume of work is very promising. So I'm pretty excited about that personally. If we can get into something though, I'd like to talk about rate in relation to what ties into rate, if we could. Because I think it's very important for the consumer to realize this. Because when you hear the rate quote out there and about, whether it be the media, newspaper, advertisement, the rates are not, this is what the rate is. There's multiple factors that tie into ultimately the rate that will be offered to you. For instance, credit score matters. Debt to income rate. Well, when it comes to rate, credit score matters. Property type matters.
Okay.
Are you buying a condo? Are you buying a single family home? Are you buying a manufactured home? Loan program matters. Are we doing conventional? Are we doing FHA? Are we doing rural housing, MISHDA, VA? The loan size matters. So there's multiple factors that play. So literally, when I'm pre-qualifying a borrower or I'm getting them a cost breakdown, I'm taking their specific financial situation into an engine that's going to give me what the pricing is. And that's so key, because if you hear, so I get this one, and I'm sure you've heard this one before too. My buddy 6 months ago closed at 6%, and now you're at 6 3/4. But my buddy closed at 6. I'm like, well, for one, I don't know if your buddy had a 780 credit score or he had a 680.
Makes $1 million, bought a $150,000 house. Dude, there's a lot of things.
We don't know if he was conventional. We don't know if he put 20% down. We don't know if his loan size was 400,000, 100,000. Like, we don't know anything about your buddy, and you're talking about a market 6 months ago. So
even 6 weeks ago,
even tomorrow.
All those things change.
So it's just very, very important for the consumer to realize that your particular financial profile will ultimately determine what your rate's going to be and at what cost that you're being charged.
To your point, again, different kind of buyer, a little bit more financially savvy, large down payment, and it just happened to be timing. When we got under contract in this house, they were able to lock him in at 6.05. And she said, if I did it yesterday or tomorrow or the day before, I'm way above this. Specifically, the day after was at 6.45. So all those things come into consideration: timing, credit score, property type. What were the other ones that you had on?
So credit score, property type, loan size, loan type. Those are going to be the major factors. So,
and I think this is a good transitional point. One, we always talk about steps of buying a house, and when you Google steps of buying a house, how do I buy a home? 1 and 2 are very interchangeable. A lot of the times, it's normally call an agent, then call a lender. Sometimes it's call a lender, then call an agent. Where do you? And I think that those steps, in my mind, those steps are the same damn step.
Well, they are 100%.
So you agree with that?
I do.
Okay.
I do. So what whenever you refer a client to me and they're talking to me, I always tell a borrower, if you are even looking at homes, whether it's the online searches or having your agent give you, send you search whatever your search criteria is, if you're even looking, get pre-approved. It doesn't cost you anything.
No.
It's a credit pull, but credit pulls, people get freaked out about credit pulls. kind of laugh about that because usually the person that's freaked out about the credit pull is the person who's got a 800 credit score and the credit pull ain't going to mean a hill of beans.
Yeah.
But credit inquiries will fall off pretty quickly. It's worth it because I've seen this book written a million times. I've had a client call me just inquiring, wanting to get info, saying, I'm not looking to buy for another year. But they're actively looking at homes.
But how are you going to know where you're going to be in a year if you don't understand where you are today?
100%.
Yeah.
And the moment you tell me, all right, I'm not going to buy for a year, but you're looking, is the moment you're going to find your house you want.
And
now you want
ready.
to act on it.
I've been dealing with this actually recently too. And he's like, hey, it's a VA buyer. Hey, I want to do these things. I'm looking for homes. I haven't had the conversation with the lender just yet because I haven't found the right house. I go, I hear you, but I think that's silly.
Doing it backwards.
And why did he not want to make that phone call? It's purely from a credit standpoint. In 2022, and I might have my years off, how many times did you pull my credit? Like four times. Yeah, like 4 times. Who gives a shit?
Yeah.
And it's not even like a worth thing. It's a I have to do thing.
Right.
It is what it is. If I want to get that mortgage, at the end of the day, it's something I got to do. But it's so short-minded to a long-term plan, and I would rather have our ducks in a row, have that conversation taken care of before we see houses. I'm cool with doing it simultaneously. I'm not too worried about that. But if we don't know where we're at and what we can afford, a great example, somebody recently, I sent them your way, and they were like, no big deal, $500,000 done and done. And I said, cool, great learning experience for me when it came down to like the nuts and bolts of it. Because it was a very specific buyer, self-employed, it was like, dude, we're not qualified for anything over $200,000, and they were mortified. So having that conversation, regardless of what your expectations are, go get pre-approved. Have that conversation.
Yeah, if I can't see your credit report, then I am really, really handicapped in trying to help you. Because now,
but John, you should give me a 6%. But John, what's my cost going to be? Guys, I can't.
Yeah. I mean, at the end of the day, if I can't see your credit report, then we're talking hypotheticals.
Yeah. And speaking
if
of,
you're this, we can do this. If you're this, we can do this. Without the credit report, if I have the credit report and I have your financial profile, now I can say you specifically can do this.
Yeah. I was going to say I hate it, which it kind of is a little frustrating sometimes when we get, but granted, all the questions we're asked are very speculative. Guy, what was the other offer? Well, we lost. So I think that, based on the conversation that I had with them, we're not going to know until 30 days from now the true facts of it. But based on, speculating, obviously price mattered. Obviously appraisal guarantee mattered. So working in this world of speculation, in a world of reality, is absolutely impossible. And two, Pat would say this. She goes, "No, it's a qualification for us. So we're not going to show you houses if you're not willing to have a conversation with the lender. It just is what it is. I can't waste my time. You don't want to waste your time, and why would you want to waste your time, Mr. and Mr. Consumer? Right. We're also dealing with that maybe twice a year.
Yeah.
Of somebody that's not willing to have that conversation, and at that point in time, no big deal." I think you're better suited to be working with somebody else. That's completely fine.
Yeah. Typically when you lay it out for them of why, back to educating, right? Usually when you let them know why they should do it, 99% of the time they'll do it.
They're like, oh, okay.
And it's not getting them to do something they don't want to do. It's educating them as to why they should. And once they get the why and they understand the why, then they typically will move forward as they should.
Yeah, it's just not knowing. And then that's why like a huge emphasis for at least our process, and I know for you as well, is just educating those consumers. Again, we want you at the end of the transaction to be comfortable, confident, and educated that every single decision you made, one, you knew what it was, where a lot of agents and maybe lenders are saying, this is what you want to do. Or those parents, this is what you want to do. And not having those people understand that. Full circle, when the second that they understand it, they're going to be happy about it or they're going to be mad about it. And I'd always want to be on the side of they're happy about it versus they're mad about it, when it's why wasn't I told about that? Why wasn't that not something that was laid out for me? And again, that can always be related back to experience. You at least know how you want to have those conversations, how you're educating all different types of buyers, whether it's first-time home buyers or seasoned home buyers. So in the big picture, the full circle, when they think back to mortgage lending or buying a house, they're thinking about John Millard and they're thinking about Palace Real Estate Group. Period.
Absolutely.
But that's the foundation of our business.
Yeah, you really know when you're successful when you get that call from somebody you worked with 10 years ago.
Yeah.
and they haven't done anything in 10 years, but they're ready to buy again, and they still remembered you.
Yeah, and you're really great about this, again, working people through a process, but hypothetically, Bob calls you tomorrow. What do you need from Bob? So Bob's prepared when he makes that phone call to wherever he is and to whatever lender he's calling. You need a few things. Yeah,
so, really it's going to be a rundown of their financial profile outside of like their particulars of like social security number, date of birth, address. It's getting a good financial profile of them. Now, typically when it comes to documentation, you want pay stubs, you want, your W-2, you want your bank statements, you want to review all that stuff. But I ask very in-depth questions because sometimes you're working in a time frame crunch, right? So if I talk to a borrower and I say, okay, I get to your income, and they say, so first off, what we need to realize is that there's mortgage world, there's real world. They can be totally two different things. So what I can use in mortgage world for your income and what you truly make could be totally two different things. And I'll paint that example. The easiest one is self-employed borrowers, right? What you make in real life, but then what you write off with the government, which you legally can do and should do to lower your tax liability. When you get to me, I have to use this number, not this number. Yep. So, but let's say, for instance, just a regular borrower works an hourly job or even a salaried position, but works overtime. So I get to their income. Okay, are you hourly, salary, commission? How do you get paid? Well, I get paid a salary. Okay, what's your salary? Well, my salary is about $80,000. Well, what is about $80,000 mean? Well, my base income is $50,000, but then with overtime, I'm at $80,000. Okay, how long have you been on your job? Well, I've only been on my job. I just started there last week. Well, I can't use overtime. Overtime's variable income. Yeah. When you get into variable income like overtime, bonuses, commission, self-employed borrowers, that's all considered variable overtime. Well, mortgage guidelines dictate to an underwriter that there has to be a block of time where they can analyze that to determine stable income.
Yep. Protection.
So, correct. So if you're working overtime or just got your bonus this year for the first 3 months you've been on the job, I'm not going to use that income. It's not going to fly mortgage guideline wise, even though that's what you make. So we're going to ask in-depth questions there. Same thing with where your money's coming from to close the deal. Mortgage guidelines.
What? I can't just have cash?
You can't just pull it out of the sky.
Where did this come from?
And you can't just get it from your buddy.
And be prepared for that too. There's certain situations where you can get gift money. In some, I don't know, but some situations you can get gift money, but one, there's a limit. And then two, we need to be able to track where that comes from. We can't just see on a bank statement $80,000 and go, time out. Like, where did this come from? That question will come up through underwriting.
It absolutely will. The underwriter will dictate. So we typically collect 2 months bank statements. The underwriter will look through the bank statement. So we got to have all pages. So if it says page 1 of 6, we need all 6 pages.
Yeah.
Most of the time, page 6 shows nothing, but it shows the underwriter it's complete. And if you've got $80,000 in the bank, but lo and behold, in those 2 months, there was a $50,000 deposit, the underwriter is going to question where that money come from. We got to document it.
Yeah.
There is things that are not acceptable sources of funds. Gift money you typically can get on almost gift money you can get on any primary purchase, like a home you're going to live in, owner occupied. Where you can't get gift money is when you go buy an investment property.
Yeah. Gift
money is not allowed on an investment property. So you're sifting through, where's your money coming from? Is it an acceptable source? So like gift money sometimes can be a little bit of a hassle for the donor. If I'm giving my son $50,000 and he's working with a loan officer, I don't want to give all my information to the loan officer. I'm gifting my son $50,000. What do you need to know? So sometimes it's important to have conversations with the client about, where's your money coming from? Oh, it's coming from a gift from your dad. Okay, well, let me tell you what we're going to ask from dad or what we're going to need from dad. Maybe we need to get on a phone call together so that we're all on the same page.
Yeah.
Because a lot of people say, I'm gonna get $10,000 or whatever that gift is from dad, and then when it comes down, if we don't have a conversation, and then when it gets down to documenting that, all of a sudden dad don't want to give up his bank statement to show where his money came from. Now we got a big problem. So
what's the common goal? We want to get Jimmy or Junior a house. You're not asking the underwriter's not asking questions that they probably even want to ask.
No,
but unfortunately it's about protecting yourself, protecting you as a consumer as well. And we're just trying to get to the closing table as fast as possible. So I always laugh about that, which every deal, well, maybe not every deal, but there are some deals that we both might know are going to be trickier than others when it comes to underwriting. And we know the other ones where they dot their I's, they cross their T's, they're going to get you docs ASAP. There's going to be zero questions versus, hey, bank statement. Hey, bank statement. Hey, we need this bank statement.
Right.
And then maybe we get involved. And I know when I'm getting a phone call for maybe it's a document or something else, then it's starting to get not serious, but it's starting to get where, hey, come on, man, like we really need these things. We haven't closed yet. Yeah, it's because they're still waiting for your bank statements, your pay stubs, or whatever it may be. So the faster you get those things in, the faster that we can close.
Yeah, typically what we do, at least in my side of the coin, is we try to keep you out of the everyday thing of what we have to do unless we need you. Usually when we're coming to you, it's because there's a delay. So because obviously we want to do our job, we want to do it fast. We're good at doing it fast, and we actually pride ourselves in our efficiency. But sometimes you're only as good as the borrower getting you stuff and how quick they're like. I always laugh when a deal goes squeaky clean, and then everybody wants to give me accolades on how great it was, and I go, well, I was only as good as your borrower was, because it was a clean deal. They were on top of things. They got us things when we needed it, And then the other side can happen sometimes. It's like, oh, that took longer than we thought. Well, why did it take that? And it's like, well, I had to get you involved for the borrower to get me what I needed.
Yeah.
If I'm coming to you and say, hey, can you nudge your borrower? That means we've come to them a couple of times and they didn't get us what we need. So, and life happens sometimes, but
you're saying
time is of the essence.
You're saying in the perspective of an agent sometimes.
Yeah.
So if we close, I don't give a shit. In my mind, I think that's funny that an agent might ever come back at you and say like, hey, dude, this was 28 days and last one was 26 days. Well, one, as you just said, they're not all created equal.
Right.
Some buyers are easier than others. What loan type are we doing? What specific is the property? So just because I closed the last one in 26 days or 30 days does not mean, and I think that's setting the ground rules for expectations for consumers and for agents. Hey, and back 2 years ago, it was give us 35 days. And we were always closing them before. There's certain situations where we're closing on the day or a little bit after, depending on whatever things. But setting those expectations for consumers and for agents to say, hey, if we close faster, awesome. But it might come down to who we're working with at that point in time. But do agents give you for not closing in files at a certain time?
Sometimes. I mean, it's very seldom and far between, but sometimes it does happen.
Yeah.
Sometimes you can say, well, and usually the ones that are really delayed are usually the tougher deals.
Yeah. And you have that proof though. You're like, hey.
So if you get that, when you do get that, you behind the scenes, I'm like, are you kidding me? I mean, like, we got them to the closing table.
Yeah, what do you mean?
Like let's put this in proper perspective, right? Yeah. It's like, look, we battled and battled and battled, and we won.
Yeah.
Like you said, and it's funny. I have a moniker that I've said over the years. I've always said, no matter how tough it is, no matter how much we fight and scratch during the process, even if someone might be frustrated, all is forgiven if it closes.
Yeah.
And that's kind of the way you got to look at it. And there's other factors too, outside factors, Chris, that sometimes will play into it. I mean, if the market's a little bit lighter, it's easier to get things through the process quicker.
Yeah.
If the market's hot and going crazy and rates are 2 and 3%, the volume's high, and people still, employees still take vacations. So your operations people take vacations, holidays still happen. So there's a lot of factors that may or may not play into how quick a deal actually comes together.
Yeah.
We give a time frame for a reason, typically 30 to 45 days, give or take. 45 days if it's a tough deal or we have a delay in the appraisal or something like that. 30 days maybe lighter if we have an appraisal waiver. The borrower's clean, they're on top of things.
Yeah.
And we're pushing the deal. So there's a lot of factors that play into that.
And that just makes me laugh because, again, my mindset is, well, one, through inspection, I'm like, my mind's off of it because we go through that kind of ghost period of not hearing anything, which no news is good news in my mind.
Sure.
But if we get to the closing table, like, what do I care? And I think it's a lot of a mindset thing. And that's been kind of like the quote of 2023, get your mind right.
Right.
In all aspects of life. And if I'm sitting here saying like, John, you didn't close it in 30 days. It took us 35 days. Who gives a shit about that? Nor are a lot of people doing that.
Right.
But it just kind of makes me laugh.
Yeah.
I think one thing that we kind of I want to go back on and cap it off because we're kind of hitting that max is a lot of people complain about the pay stubs or the documents needed. A lot of people complain about things, but why does that matter? And again, it goes back to people just have such short-term memory. They're not thinking a big picture. Back in 2005 to 2008, maybe you didn't need all those things. So it matters for protecting lenders. It matters for protecting consumers. And ultimately, the government and banks don't want to go through that shit anymore. So it matters.
Yeah. So you bring up a lot of good points there. So back in prior to the credit crisis of the 2008-9 era, it was a lot easier to do a loan. I mean, if you could breathe, we'd get you a loan. I mean, you had stated income, no doc type programs out there.
Yeah, just stated income, which give them a snapshot. Today, you need to prove your income. You can say, no, I make $200,000.
Right. If you had a high credit score and you had money in the bank, and you were self-employed, we would do a stated income, stated asset, no doc type program. You would pay a little premium for it, but we could still get you a decent rate and close the deal. Then the credit crisis of 2008, 2009, and the pendulum swung all way to the extreme, where I was literally telling clients, look, I'm just going to warm you up. By the time we're done, you're going to think I took your right arm. Yeah. The good news is still deals are still closing, but just hang with me. And you try to set that proper expectation so there was least frustration. Now that we've swung a lot back, quite a bit from there, it's not quite that bad, but there's still some remnants of documenting, over documenting. One of the things, to come to the defense of underwriting is you got to keep in mind that when that underwriter closes the book on that deal with their approval stamp on it, that loan gets sold on the secondary market to an investor. And if that loan doesn't get bought, the company doesn't free up that money to go lend it again and don't make the revenue on it. So underwriters, sometimes it's not that they're just being, overly cautious or mean or want to over document. It's their reputation. Quite frankly, their jobs are on the line. If they're stamping an approval and that loan don't get bought, and they do that too many times, they're in trouble. So sometimes it is. Now, sometimes you can get, you can work things out with underwriting to where they wanted this, but after talking it through with them, now we've got to something a little bit lesser that makes it a little bit easier on the consumer, which is always my goal. Yeah. To me, the less times I touch the consumer and the less that I have to come with something to make them go digging and scratching for their documents always helps. But to the underwriter's defense, it's their name on that approval when it's all said and done. And so I don't envy their job at all in a lot of ways. But
and they play a key role in the lending institution world for protecting consumers, protecting banks, and making sure that those banks still make money in the big picture.
100%. Lending a lot of money.
Something happened recently to us, and then to your point, it's about job. It's about protecting your job at the end of the day. It was a VA loan or something, or was it RD loan or an FHA loan, and I don't think we pulled water. And one of those loan types need clean water.
VAs requires a water test typically.
We closed. And the underwriter specifically called me up and said, I messed up. We need this. And we'll take it in stride, Chris, because of what the water is going to look like, for better or worse. But if it comes back dirty, we'll figure it out. But I just need water. Luckily, it came back clean. And I never saw her. It actually might have been one of your deals, but no, I don't think it was.
I think you told me about this, but I don't think we were the one on the deal.
No, and they came back at me and they said, "Oh my goodness, I can breathe." Because if she made that mistake and there was dirty water, what was going to be that cost? A few $1,000 probably at the end of the day, but that's could be the difference of keeping or losing your job, unfortunately. So it's really protecting themselves and those banks.
And it speaks to the human aspect of what we do, right? I mean, you can't always dot every I and cross every T. You can't always have. I mean, this business can be so tedious sometimes with all the guidelines of dotting I's and crossing T's, and it just goes to show the human aspect of it. That underwriter might have done who knows how many deals perfectly fine. Yeah. And on this one deal, it slipped through the cracks. And
she's probably done thousands.
You're right. Yeah. So they don't have an easy job. No. It's not an easy job to do. They're the for the general public, if I could just say this in the most respectful way that I can, is we just have to remember who's lending who money. Yeah. If you're lending me $400,000 and you say, John, to lend you $400,000, I need you to do A, B, and C. I need to do A, B, and C. Yeah. If I don't want the $400,000, then I need to go I mean, what do I do? If that's your requirement for $400,000, I have to be willing to do it if I need the $400,000. And that's a real layman's way of putting it.
Yeah.
But sometimes that gets lost in the mix of, why do you need this from me? Why do you need this from me? Why do you need this from me? Well, we need it because we're adhering to a guideline that is government regulated.
Yeah.
And that allows us to go get our money after we've lent you the money.
Yeah.
We don't make a ton of money off the borrower. We make our money by selling it on the secondary market, freeing up our cash line to go lend that money again, and doing that over and over and over again. That's the business model that makes the lenders money.
Yeah.
And sometimes you don't want to get too much into those weeds of explaining that to the borrower, but sometimes it's worth the conversation to go, hey, I know you don't know how we make our money, but this is how we make money. I mean, this is how we have to do the things that we have to do.
Especially with a loan with a low down payment, though, like they don't necessarily, that picture is not painted for them, and realize like you guys are asking for $400,000. Like there is gonna be some quid pro quo when it comes to what we need you to do to make sure that we're buying those things. And the banks have the memory. They realize that what the process was, who was borrowing this money, and the people not being able to afford those mortgages in a worst case scenario. Because at the end of the day, you lose your income, you're not able to work, you default, it goes to short sale or foreclosure. Who's taking the hit on that? The banks.
Right.
And there's two probably industries that run this world: finances and marketing. And you're not going to win that battle when it comes to that. It's either you want the mortgage or you don't want the mortgage. So play by the rules. You're playing by the rules.
100%.
We play by the rules. Consumers play by the rules for the most part. But realizing that we don't necessarily enjoy putting you through the grind on these. But at the end of the day, we're going to get you a house. You're going to win this house. You're going to be in this house. It's going to be the best rate for you, customer service, so on and so forth. I was going to bring up one last point. I forget what it was. I think it had something to do with the process. If I think about it, we'll probably just throw it in there. Anything you want to cap out. We've touched on a lot of great things. Yeah. Why rates are where they are. And that's the unfortunate reality with a lot of this stuff is there's not a single answer.
Yeah. So
a lot of factors.
Yeah. And I want to speak to the point of the rules too. You know, I always joke with clients, if you're a client of mine, you probably heard this from me, is I always say, hey, when there's times I got to make a call to ask a borrower for something that I don't want to ask them for that. And I might not even agree with the rule. Yeah. And I always say, man, I don't make the rules, but I'm stuck playing by them. Yeah. So, and when I do that, typically the borrower understands, and they understand, hey, I'm on your team. I'm on the same team as you. I'm here to get you to the finish line. Sometimes I got to make the call that I don't really want to make because I don't agree with it, but we're stuck playing by the rules. And and then I would say to rates, I think this is the new normal. I mean, or what should be more normal.
I'd be cool with 5.5 fixed for the end of time. Yeah. So and we're kind of right there. We're probably going to get down to 5.5. How long until we get to there? To be determined. But I'd be cool with like a 5.5 fixed rate for like the end of time.
Yeah. The rates are really not that crazy in the grand scheme of things. They're just different than what they were when they were unreasonable.
Yeah, that's what I was going to say. People love to look at me and go, well, what's going to happen tomorrow, 6 months in? And you get a lot of people that say we're crashing. And I say, time out. I hope the institutions learn their lesson in how they lend money. Check, we've done that. We have rules and regulations. 2, interest rates do have a big factor, I guess, on supply and demand, but that's the bigger question is we're still in a seller's market, even with rates where they are, because of supply and demand. And the data that I always go back to is 1, we've got the average borrower has more equity in their home than they've ever had. I think it's above 25%, the average borrower. 2, people are making a lot more money than they had to, statistically on average when it comes to a buyer standpoint. 3, millennials are the biggest buying demographic right now, and millennial is somewhere between 28 and 48. So people now are buying homes later, so they have lower debt to income ratio, making more money. You see a lot of combined people on mortgages. So even if I lose my job and you're on that mortgage with me, we're still able to make those payments. So Mr. Consumer, Mrs. Consumer, with all those things to take into consideration, I still think we're very, very healthy in terms of a market. And then 2, one thing that I always capitalize on or circle back on is just because we're in a recession or there's a correlated recession that's going on right now doesn't always directly affect property values. When you look at the last 8 U.S. recessions from today to 1910, not all of them had drastic appreciation. And actually, when you look at all of those, only really 2 did. 2008 was, 30%. One of them in the 90s was maybe, 3%. But in the big picture of appreciation, we're talking about nothing. We're talking about a freaking blip.
Well, and I'll tell you in my, my personal experience, with the house I live in, I mean, when the credit crisis happened and the values were pretty low, came down quite a bit. I just waited it out, and
time heals all wounds.
I'm perfectly fine with where my equity is now. Had I sat on the sidelines because I was worried about, what's the market going to do and okay, but you're paying rent. If you're paying rent, you're paying literally just for the roof over your head for that month. So for as long as you wait, if you can, it's all about affordability, right? If you can afford a house that you're looking for, all the other factors, no matter what market we're in, all those other factors are always going to be unknown. Yeah. You're always one step away from a recession or one step away from a boom. You're always one step away. So if you can afford the house that you're looking for, and that's another thing real quick, it's about affordability, qualifiability. I always talk borrowers, look, I can tell you what you qualify for. Only you can tell me what you can afford. Yeah. We want to stay here. We want to stay where you can afford, where affordability is for you. And I think if you do that, long-term wise, it's a healthy decision to make. If you sit on the sidelines, whether it be waiting for rates to drop, okay, you're waiting for rates to drop all the while you're not building any equity in your home. You're paying, some people say, you're wasting money on rent or whatever. So I think if it's affordable and you can do it, and I said this to my own children, when they were buying their houses, I'm like, if you're ready to buy a house and it's affordable for you, then it's, you can't time the stock. Like even the best stock investors on the planet can't time it perfectly. Yeah. Why are you going to try to time it perfectly as just a home buyer? Like if you're in the market to buy, it's affordable. Why would you not do it? Yeah, if you can afford it. And let's close out on that is just from our experience, when we were at 3 or 3.5, the amount of people that said, oh, we're going to wait for it to crash. And now all of a sudden, 6 months later, we're at 7%. We haven't, quote unquote, crashed. Have we seen a little bit of a blip? But over 2020 and 2021, the 20% of appreciation, if we go down 10%, we still have appreciated year over year, 10%. 100%. So yeah, and that's the media focus of foreclosures are up. But we've had a foreclosure moratorium for 2.5 years. Yeah. So yeah, foreclosures are up because now they're allowed to do them in 2023. And that's why it's so important to get the facts, the education, but then also take those things as a grain of salt. How does it affect you as a consumer individually, not as the market as a whole? So affordability, know what you can afford, stay within those scopes. And then two, to that point, maybe back in 2008, people were way above their affordability. We want to buy that $700,000 house. Young couples right now, they're making buku freaking bucks, $400K a year, and they want to spend $325. Right. And they were well qualified to buy something 3x that. So thanks for coming on. Yeah, we didn't start with this. John Millard, John Adams Mortgage. What's your cell phone number? What's the email address? How can they, if they need more information, if they want to refi, how are they getting in contact with you? Yep, you can. That one's the only one on now. You can reach me either via my cell phone. You can text or call at 248-225-5169. If you want to shoot me an email, that would be J Millard. So my first initial last name, JMILLARD, and that's at John Adams with an S, Mortgage, MORTGAGE.com. We got to work on making that second half of the email address just a little bit easier, like JDA Adams at or whatever. I think it should be John Millard at Jamco.com. Jamco, done. We call ourselves Jamco inside the company. Yeah. And for whatever reason, I don't know if it's something they can't get or whatever. I wonder how many emails you've missed because of just like a slight misspelling. It's a long email. So best thing to do is call or text. Yeah. Shoot him a text. Shoot him a call. Thanks for coming on. Appreciate it, sir. Had any perspective on lending. I think that's massive. And honestly, we could probably have a podcast every single week about the change in the market. Maybe not necessarily the specifics on the exact correlation, but it's a conversation that people need to see and people need to have for the education. So thanks for coming on. Appreciate it. Thanks for tuning back in. Beyond the Keys, Pat Lotz podcast. As always, there's lots to love in Livingston County. See you in the next one.
Thanks for watching. Make sure to use those like, comment, and share buttons below. And don't forget to follow us on Facebook and Instagram, and subscribe to our YouTube channel at Pat Lotz Real Estate for more helpful home buying and selling tips. Want a free comparable market analysis? Scan that QR code on your screen or visit our website at www.patlotz.com and fill out the request form. There's lots to love in Livingston County.